Welcome to this walkthrough of the mini storage financial model from efinancialmodels.com. This is a financial model template for a mini storage business. A mini storage business is it's basically a storage facility which is rented to individuals and small businesses within a 20 minutes driving distance. And especially for real estate owners, this has been it's a very interesting concept, because in case it's difficult to rent a storage facility, this can be a good way to convert a commercial storage facility and put something on the market which can be rented to individuals or smaller business owners. And also the compartments rented will be rented by cubic meters at quite higher prices than what you normally pay if you just rent normal storage facilities. Mini storage businesses are normally operated on a on a self-service basis, meaning the tenants receive badges or a PIN to access the property. They come there themselves, they put stuff in, they take stuff out. There is nobody on site on a permanent basis. So this means the the costs and the personnel to operate such a mini storage business is very low, and it's very managed in a very lean manner. So let me shortly show you the structure of this model. As you can see, this model has different worksheets. The most important worksheet is the executive summary. The executive summary contains key assumptions and also the key results of the model. There are different topics to be covered. One is basically how the financial projections look like, what are the financial ratios, including ratios of relevance to bank or also of to investors. How does the balance sheet look like? What's the pricing basic pricing policy look like? What's the cost structure look like? How many employees do you need? And then what does this mean in terms of the financial feasibility? What's how much project and equity IRR can you expect from this project? And the model goes on, also gives you here a summary of the expected profits. And if you want to take also co-investors on board, you can split the levered profit, meaning the profits to equity investors, and further split it between one share going to the founders and one other share of the profits going to equity investors. And below you have here all the more detailed assumptions for how much are the costs to build actually the storage business. The business, basically the model itself includes two use cases. One is to rent a property and one to buy a property. So you take two views. Either it's a pure business for you, or it's basically you look at it from a real estate perspective and you just want to use one part or the biggest part of the property for a mini storage business. In that case, this would mean you might have here the majority of square meters is reserved for your mini storage business, but you might have other other floors or other spaces which you will rent as normal areas to third parties, basically. And then here to finish this, you also have here the rest of the assumptions, the cost assumptions to operate the mini storage business, the policy on depreciation, how much working capital you need, tax rate, and dividend payout ratio. So that's on the executive summary. You have a next sheet, which is basically the rent roll. This means if you just look at the mini storage part. Mini storage, you have different compartments. You have here a list of about up to 100 compartments. You can say how many of each one you have. What is the volume per compartment? You basically rent this on a cubic meter basis, but this also means you have square meters and height. And this model, what it does, it allows you that you can basically project your income from this rental of cubic meters over the next months. You have here a bit further down below, you have here a ramp-up schedule included, meaning you are basically forecasting occupancy rate to change. You start with a business fully fully empty, you fill it up, and at the end, basically, you end up with a target occupancy rate. This basically comes then here from the executive summary. And this way, you build basically the rent roll of the mini storage business, and it gives you here the rent roll. You have a next sheet with more detailed schedules for the business. You have schedules for your employee costs. If you are a property owner, this means you, as I showed you before, you also have income from from other spaces. This would be listed here. You have then the fixed asset schedules. You see here I'm renting the facilities, but if I now switch to another scenario where I'm basically the property owner, this means I invest in the facilities, then basically the model takes the assumptions for CapEx, meaning here I invest 4.1 million in the building and 700k in the land, and this basically ends up as gross fixed assets, and then will also be depreciated with the next schedule here. And also included is a debt financing schedule where you can basically input what's the interest rate, how much of the debt facility here we go to 300k, then it's basically you can forecast how much per year you need to repay. So there are 3 layers of debt basically included in this model. And then the next sheet is basically the financial projections sheet. You have here, it's a 3-statement model, meaning it has an income statement, a balance sheet, and a cash flow statement. Then there is also a schedule for the financial analysis. The next section is dedicated to the Project IRR DCF valuation. For this, you need to calculate the free cash flow to firm. This is done here over a period of about 5 to 6 years, depending on the exit year you choose. This how many years are included. At the end of the forecast period, if you are renting your property, your premises, then basically it applies a 5 times EBITDA multiple. If you are a business owner, then basically you can see then the exit valuation model changes because you look at it from a real estate perspective. And in that case, what you do is you take the estimate, or basically the market income which you can get from the property and capitalize this by the gross cap rate. So this allows you to build different scenarios and then basically to come up with the IRR of the project. If I come back here to rent, I can also show you the other variable which is of interest is the cumulative free cash flow to firm, and you see here this peaks in year 2. This is the minimum reached. And this also means you need to find a way to finance this gap. This is the amount of financing required. And the model then basically gives you here the minimum funding required to do this project. You have here the unlevered profits as well. So how much at the end is the profit of the project. Then the same analysis can also be done from an investor point of view. The difference is the debt financing. Investors benefit from leverage. So you have here the reconciliation. You start with free cash flow firm, but at the end you are focusing on free cash flow to equity. And then you can basically use a similar calculation to figure out what's the levered IRR of the projects, the levered profits, etc. And this gives you different multiple, which you then also find again in the executive summary that you see if you lever it, you lose a bit of profit, but you only need to that's the part of financed by the equity, and in relation to that you see you get a higher multiple on your equity investment. Okay, and then to finish that, for equity investors, you can also split the profits. One part goes to the founders, the other part to investors. And if you have co-investors on board, then this model allows you to to basically to have a framework to figure out, okay, if how to split the equity portion. One portion goes to the founders, one to the investors. What does this mean in terms of their IRR and their multiples? If this might be different for some scenarios. So to wrap up, overall, as you can see, what you can do with the model is you can basically run rent or buy scenarios. You can figure out what is the required funding of that of that mini storage business. You can also play with your pricing model. If you have here the different boxes you want to rent, and basically you can here basically try different pricing model, how does that work for you for the project basically. And more also you can basically play around with the debt financing structure and optimize this so that you have a reasonable basis to talk to your bank. Okay, I hope this this walkthrough was useful. If yes, please give it a thumbs up. Don't forget to subscribe to this channel, and please visit our website efinancialmodels.com. A link to the model is also included in the description below. Thank you for watching.